Let's talk about a decision that feels overwhelming but holds the key to saving a massive amount of money and stress: choosing your mortgage lender. This isn't just about who gives you the money. It's about partnering with an institution or a person for what could be 15 to 30 years. Get it right, and you secure a competitive rate with smooth, reliable service. Get it wrong, and you could face hidden fees, closing delays, or even worse, a deal that falls through at the last minute. With so many options, big banks, local credit unions, online lenders, and mortgage brokers, how do you possibly choose? The answer isn't to just pick the one with the lowest advertised rate. That's a classic beginner mistake. The right choice is a strategic blend of numbers, service, and trust. In this guide, we'll walk through a proven, step-by-step process to vet and select the best mortgage lender for your specific situation. We'll cover the different types of lenders, the documents you must compare, the non-negotiable questions to ask, and the red flags that should send you running. By the end, you lines have a clear checklist and the confidence to choose a lender that won't just give you a loan, but will guide you successfully to the closing table. First, you need to understand the playing field. There are four main types of mortgage lenders, each with pros and cons. The first is the big national bank. Think Chase, Bank of America, Wells Fargo. Their pros are name recognition, extensive technology, and sometimes package deals if you're an existing customer. Their cons can be impersonal service, slower processes, and less flexibility if your financial situation is unique. The second type is the credit union. These are member-owned, not-for-profit institutions. Their huge advantage is that they often offer lower rates and fees because their goal is end shareholder profit. They also provide highly personalized service. The potential con is that their technology might be less sophisticated, and they may have more restrictive membership requirements. The third type is the online, mobile-only lender. Companies like Better, Calm, or Rocket Mortgage. Their big sell is speed, convenience, and often very competitive rates due to lower overhead. The potential downside is the lack of a local, dedicated person you can sit with face-to-face if things get complicated. You're often dealing with a call center. The fourth and most important type for many buyers is the mortgage broker. come prepared with a list of questions. First, ask, what is your average time to close a loan? A good answer in today's market is between 30 and 45 days. If they say 21 days, be skeptical. If they say 60, be concerned. Second, ask, will you be my single point of contact, or will I be handed off to a processor and an underwriter? The best scenario is a dedicated loan officer who manages your file from start to finish and is always available to answer questions. Being passed around a department is a recipe for dropped balls. Third, ask the most revealing question of all. Can you provide references from a few recent clients, or do you have online reviews I can read? You want to hear about the experience from the borrower's side. Listen for comments about communication, problem solving, and meeting deadlines. Fourth, ask about their underwriting process. Do you do underwriting in-house, or is it sent to a central office? In-house underwriting is typically faster and allows for more direct communication if issues arise. There are also major red flags you must be aware of. If a lender is hesitant to provide a written loan estimate and only wants to talk in vague terms, walk away. If they pressure you to sign documents immediately or tell you not to worry about certain fees, that's a huge warning sign. Be wary of any lender who suggests you should falsify information on your application, like overstating your income, even slightly. That is mortgage fraud. Another red flag is a lender who doesn't ask for many documents up front. A professional lender will want to thoroughly vet your financial picture from the start to avoid surprises later. A lender who seems too easy, who asks for nothing and promises the world, is setting you up for a denial at the last minute. Trust the lender who is meticulous from day one. Finally, consider the life cycle of the loan. Ask, do you service your own loans, or do you sell the servicing rights after closing? Many lenders sell the servicing, meaning you'll send your monthly payment to a different company shortly after you move in. This isn't necessarily bad, but it's good to know. Some borrowers prefer a lender, like a local credit union, that is known for keeping and servicing their loans for the long term, offering more consistency. Weigh all these factors, the hard numbers on the loan estimate, the soft skills of the loan officer, the lender's reputation, and your personal comfort level. The cheapest loan from a frustrating, uncommunicative lender can cost you your sanity or your dream home if they can't close on time. The goal is to find the optimal balance of competitive cost and exceptional, reliable service. Take your time, do the homework, and choose a partner, not just a provider. This decision will echo for decades, so make it with both your head and your gut fully engaged.